Well, thank you everyone for joining. This is the Charity SORP 2026 Lease Accounting 101 webinar. We'll be here with you for about an hour and taking through various different parts of this particular area of the new SORP. And I'll kind of reflect on some of the things that we'll be covering in terms of the webinar. So just in terms of introductions, hopefully you've probably seen both Joe and I before from previous sessions, but just to say that we're both audit senior managers at MHA, working in the not-for-profit team here in London, working alongside Stuart and Sadir, who I'm thinking you might be a bit more familiar with, having been in the sector for a while. And so let's begin in terms of this webinar. So we will be taking you through the SORP lease accounting module, thinking about the new requirements that have come in place for 2026, comparing that to 2019 SORP and how that may differ. And then Joe will kindly take us through the implementations and thinking about the practical side of things, using worked examples to take you along that journey. It'll be about a 45-minute sort of session, and then we'll leave about 15 minutes for the Q&A to the end. What I'd ask is if anyone wants to ask any questions, please use the Q&A function of the meeting rather than the chat, and it'll be easier for us to kind of track through any questions at the end. So one of the things that we always just wanted to highlight is that there have been some previous sessions in terms of this webinar series looking at the SORP. And these can be found on the MHA Trustees Hub. So we've just put a link below on the screen as well. You would have probably joined us maybe for the revenue recognition 2 weeks ago. And so my understanding is that recording is now on the hub for any kind of refresher that you might want to have or maybe want to share with others in your kind of circle or network. We'll be recording this session, and therefore hopefully in about a week's time you'll be able to see this as well. And those that have signed up to this course, they will probably also receive the copy of the slides as well. There's a lot more within the Trustees Hub in terms of some guidance notes and some previous sessions around kind of the general changes to the SORP that were kind of covered by Stuart and Sadir early on. So let's take us through understanding the new requirements. And we were thinking about how do you kind of determine what's changed. And from an overview, we were looking at, okay, what was there in the previous SORP? And interestingly, there were only 2 paragraphs. So you may have missed it, having read through the SORP over the few years. And there's only a section called Accounting for Hire Purchases and Lease Arrangements. Those 2 paragraphs sitting under the kind of fixed asset section of the SORP. But in the new SORP for 2026, there's a whole new module, Module 10B, called Lease Accounting. And it's got a number of pages, I think about 28, which therefore kind of indicates that there's a significant amount of change that has happened, and it reflects on the changes obviously that's happened with FRS 102. So there's quite a bit of information, so we thought we'd try and digest that in its sort of parts. If we reflect on the previous SORP, it mainly referred to FRS 102, which is probably why it was only 2 paragraphs long. It clarified kind of the consideration of substance over form, and it kind of made reference to kind of finance leases.
That was it, isn't it?
It was. But in terms of the new SORP, it still signposts quite a fair bit of the guidance to FRS 102, but it does have a whole module so that you can refer to specifically when it comes to looking at your leases. It removes the difference between kind of a reference to operating and finance leases for lessees. And it very explicitly says that this applies to all tiers. So though there might be a bit of a tiering system for some modules within the SORP, for lease accounting, it's for all tiers, so effectively affecting all charities in the sector. What we found quite useful with the SORP is that it has provided the extra detail and some flow charts and examples, which will be useful for you to kind of refer back to if you needed to. And I've just put the depiction of a flow chart on the right side of this slide, which I think is useful to kind of understand how to apply the module. I think it's written in a reasonable way that it's not too technical. So maybe those that might be involved with helping you put together your kind of lease arrangement documents that might not be in the finance sort of team, this might be something useful you want to share with them to help you kind of go through your decision process and help you kind of navigate through the changes. So, for example, it sort of starts off just effectively saying, does your charity have an agreement to use an asset that belongs to someone else for a period of time? Follow through the kind of flow charts and thinking about, what's the arrangement in place in terms of the value, and as well as kind of the agreement in place, and also the timing of that. And as you work through, it will indicate to say, okay, which part of the module does that apply to you, and how you would need to account for it. So I think the SORP has been quite good in terms of taking us through the step of identifying a lease, the lease term, whether you've got a lease, then thinking about the right of use of asset and the lease liability, which will take you further in a bit more detail. They have made reference to some exemptions, so that will be useful to be mindful of in that decision-making process, and also thinking about some nuances such as non-exchange transactions that might be part of a lease. The SORP 2026 does make reference to the accounting for lease or accounting and sale and leaseback transactions. In terms of this webinar, we won't be going too much into the detail on this because not much has really changed in terms of the accounting on that side of the transactions. So this is particularly in relation to the lessees, that we'll be looking into. So sort of step one is thinking about, with your arrangements, do you actually have a lease in place? And so the SORP clearly kind of notes that a lease is a contract or part of a contract that conveys the right of a use of an asset or an underlying asset for a period of time in exchange for consideration. So there are fair parts to this. So have you got a contract in place? Have you got the right to use that asset for a period of time that is usually clearly defined in the agreement, and also in exchange for a consideration? And that's about, I think, identifying if you've got the economic benefits of that identified lease. The SORP does note that, some contracts may have a lease element and a non-lease element, being maybe some other services provided in providing the asset. So it would obviously recommend to separate those out so that you can then account for the lease element, but has made reference to obviously thinking about the practical considerations, that if it's not easy to, it's kind of split out, or it might be sort of more nominal in value in terms of the non-lease component, that it can be considered as a lease as a whole. So that's kind of first step, thinking about, have you got a lease in place? Then we need to think about the terms. So the lease term begins at the commencement date, or when the asset is available in use. And we need to think about, are there any other parts to that, including rent-free periods? So trying to identify what your lease term is can be a little bit tricky, because it has slightly changed from the previous considerations from the SORP 2019. So what you need to think about is your non-cancelable period. That's kind of usually pretty explicitly stated. But then you'd also need to think about the period covered by options to extend if the leasee is reasonably certain to willing to do so, or periods covered to terminate if a leasee is reasonably certain it won't do so. So that can vary depending on the different leases you have, different sort of arrangements you've got in place, and also whether it's kind of explicitly sort of noted. And so that's part of that decision making. And I think it might be factors to consider that are quite judgmental, because it might be a decision on, how do you know whether you're planning to terminate? And is there like a cost impact to terminating, and could that implicate your kind of decision on doing so? Equally, in terms of extending the lease, are you well sort of settled in your kind of building, for example, with all your kind of operating activities, and do you foresee that you won't be passing that kind of you won't be utilising that break clause and actually willing to kind of extend to the full term of the lease? So once you consider those parts, you'll be able to get your kind of lease term. The next stage is thinking about recognising the lease's measurement, and I suppose thinking about the two parts of that. So the right of the use of the asset and initial measurement, recognising it at cost. And then the other part is measuring the lease liability, and that's the lease liability at the present value of the lease payments. So this is where you'll be thinking about getting your kind of I suppose the knowledge from previous sort of financial qualifications or training that you might have when you're thinking about discounting. And so The SORP is aware, and I think it makes reference from the FRS 102 as well, that discounting can be determined by looking at your interest rates. There could initially be an interest rate that's implicit in the lease arrangement and in the lease agreement. So if it's already noted there, obviously that would be what you would apply. Failing that, then you'd think about, do you have any borrowing rates within your organisation? Maybe that would be your kind of baseline for your discount rates. If those don't exist, then it is noted in the SORP that you can think about the kind of deposits that the charity may hold, and using that as an estimate as your interest rate to apply. So this is another area of judgment, and that will require you to consider what kind of percentage you'll be looking at. When we're thinking about initial measurement, we also have to think about other parts to that arrangement. And we need to think, are there any lease incentives? If so, then you would reduce your lease payments, and that will be included in your calculation reflected in your lease liability calculations. But you would also reflect that against your cost in terms of your right of use asset. There could be some dilapidations as well, especially if you're kind of renting out a building, and therefore you'll be thinking of amending that, adjusting that to your cost of your right of use asset, but being mindful that actually that doesn't take part in your liability. A separate provision would be recognised instead. So there are a few different things to consider just at the first stage of your initial measurement. But once you've got all that information, you'll be able to then set out what are the figures that you're using to then take you through your calculations, which Joe will take us through the worked examples, and that have I think will be easier to follow through. Then we have to think about subsequent measurement. So you would measure your right of use asset applying the cost model, but you would reduce the cost accumulated depreciation, usually over your kind of useful life of the assets, effectively maybe your lease term. And you'd also think about impairment losses over that period as well. In terms of your lease liability, you'd be looking at the carrying amount, and that will increase by the interest on your lease liability, but it was also decreased by the lease payments that are made. And this is something that I think when you're doing your subsequent measurement, you'd obviously assess that at year end as well and think about, has anything changed? Was there anything that changed partway through in terms of your future lease payments? Were there any modifications to your agreement in terms of the scope of the consideration? And if so, that needs to be factored in as well. We next wanted to just highlight some of the SORP where it makes reference to some exemptions, and this might be something that a lot of charities will be looking to think about, do I have to take on this lease accounting changes? And the SORP is aware that, there are some items of assets that are in use that may be sort of seen as low in value or be on a short-term lease. So if it's a short-term lease, the consideration is a lease term of 12 months or less. However, if there's a purchase option within that lease, then it cannot be treated as a short-term lease. But these modifications need to be assessed as well. So for example, if you started a lease and then something has changed partway through, you'd need to kind of reassess, does that fall into that category as a short-term lease or not?
Like, for example, a change in judgment about whether or not you're going to exercise a continuation or a termination option.
Yes, yeah, which is why this is probably not just a review at the beginning stage of this process, but kind of an ongoing assessment each time. The next area is relating to low value exemptions. So there isn't a definition specifically in the SORP about what you would consider as low value. So this is very judgmental, and I'm sure quite a bit of chat has been going around in terms of what do we consider something to be low value. FRS 102 is trying to be a bit of a help in trying to say what they wouldn't include as a low value item. So that's cars, vans, lorries, boats, production equipment, and land and buildings. But I don't think they make much mention of anything else. The SORP tries to add a little bit more value to this, and they have said that typically you may consider a low value asset to include personal computers, tablet devices, small items of office furniture and telephones. But Joe and I were kind of thinking, what would you consider to be a personal computer in the nature of, working at the charity and those kind of assets? So there may still need to be a consideration internally as to what you would consider in that category. There may be consideration as well in terms of any exempt leases that may stand alone items or kind of have any resources that are needed to be dependent on. So be mindful of that in terms of your variation of the asset types that you've got. The value of the lease payments has no bearing on determining whether it's a low value lease. So I think that's something to be mindful of, that it's about the absolute assets, the item itself, rather than, materiality or what you may perceive to be, I suppose, lower in value. But it might be just based on the category of item, I would have thought.
Yeah.
The fourth area that we wanted to just highlight in terms of the SORP was thinking about the newer kind of concepts of reflecting on non-exchange transactions that you might find within a lease agreement. And this reflects on, are there any payments that you're making that's below market rates, but higher than a peppercorn rate? This can be also quite difficult to determine because you'll need to establish the intentions of your lessor in terms of what they're giving you and at what rate they're giving it to you at. And this would be considered maybe as a social contribution, a social donation, and therefore you would recognise this part of the element of the lease as a non-exchange component, and you'd recognise that as part of the income going through. But depreciating your assets may also slightly change because of that element of social donation that will be deducted. And so this is something I think Joe will reflect on in a bit more detail with an example. And then I mentioned previously about peppercorn leases, and if you joined the income recognition session a couple of weeks ago, we did draw upon about how does that get recognised, and under the new SORP it is thinking about if it's not part of a contract and there's no, if it's a contract but there's no exchange, then it would be considered as a peppercorn lease. And so you would need to account for it as a donated facilities and services. So thinking about it as the value to the charity, which has an element of estimation involved as well. And so you would think about accounting for that through your income and expenditure. So Joe, would you like to take us through
what a lot of theory. Yeah. Thanks very much, Joanne. Yeah, I mean, so much to kind of process and go through there, so much judgment to consider. And so when it comes to thinking about how am I going to implement this, how am I going to, what am I going to do on day one of needing to implement this, I think it's really important just to lay out some of the facts, some of the basics, right? So remember that the charities, you must apply this new accounting treatment for leases from your accounting period beginning on or after the 1st of January 2026. So all of our charities out there with December year ends, we're already in it. So we're already a month in. Hopefully this isn't the very first time you've been thinking about it. If it is, don't worry. Hopefully by the end of this session, you'll feel a bit more confident about what that to-do list looks like. For our March year-end charities, it will be the 1st of April. That's the first day of that accounting period to which this treatment will be relevant. So you've got a few more months to go, but still not a huge amount of time. Obviously, charities with year ends later than those, you've got even more time. But yeah, it's coming up. It's happening now. I think the SORP it doesn't go into huge amounts of detail itself about how to implement this or what first day transition looks like. It kind of sends the reader straight to FRS 102, and hey, why not go to the kind of bedrock of this guidance. And for those who joined the revenue recognition webinar a few weeks ago, we talked a little bit about the fact that there was an option in terms of how to implement this new accounting treatment. There was the modified retrospective approach, where you're thinking about the cumulative effect of these changes and recognizing that as an opening balance adjustment, or the decision to kind of treat it as a change in accounting policy and go back as far as practicable to work out what impact is and then restate it. Thankfully, I think the SORP doesn't allow, or FS 102 doesn't allow you that option when it comes to leases, because who in their right mind would really go back and reassess it from day one? It's just that modified retrospective approach that we're mandated to take. I think that's good in some ways, because it means that we are not allowed to restate comparative information. There's no need to restate, so we don't need to worry about that. But we do need to think about that cumulative effect of each lease that we are treating under the new guidance. We've got a little kind of screenshot of what that might look like in your financial statements. What does that modified retrospective approach look like? Just a small little opening balance adjustment, not a restatement, but an opening balance adjustment, hopefully with a bit of narrative as well to kind of support it along the way. So it's day one, or I'm approaching day one of my new accounting period. I'm starting to think about what I need to start doing. The SORP, and again, references FRS 102. It provides even more detail, thankfully. And it says specifically for those leases which were previously classified as operating leases, we need to apply that new treatment. We need to recognize a lease liability. And we need to recognize a lease liability at the date of our initial application, which is the first day of the accounting period that we're applying the new SORP, so the 1st of January, the 1st of April. And we measured that lease liability in line with what Joanne was explaining to us earlier, but we treat just the present value of the remaining discount lease payments. So it's not as if we're stepping into an existing lease, we're just considering an existing lease almost as if we were at day one of it again. So the example that we kept on going back and forth about internally here as a team was, say I've got a 5-year lease, and by the time I get to my initial application date, I've got 2 years to go. What do? You treat it as if it's a 2-year lease only, and you discount the future payments in those last 2 years. Okay, so we're reassessing our lease. When it comes to our right of use assets, again, we need to value that. We value that FRS 102 is quite clear at an amount that's equal to the lease liability, considering any prepaid or accrued lease payments that we might have accounted for just before that initial application. So that's a bit easier, I think. But we need to consider some of those other elements that Joanne, you were talking about. So, the social donations, were they present? Is there a discounted lease payment at that point in time at our initial application? That might impact our opening balance adjustment for sure. We need to think about whether or not leases are modified. Are we coming to our assessment at a break clause date, at a date only a year away from a break clause? Do we need to think about whether or not we're going to exercise that or not? So we need to kind of go through that whole process again. The good news, as Joanne was saying, low value leases, we don't need to consider those in too much detail. We don't need to adjust for those. We don't need to worry about leases that are ending within 12 months from that initial application date. So quite a bit to consider for operating leases. I think FRS 102 is quite clear about how to do that. It's also quite clear about what to do with finance leases, which is very little, thankfully. We need to recognise a lease liability and a right of use asset, but we do so at the carrying value of the lease asset, which hopefully if we were accounting for that under the previous SORP accurately, we would have already had those numbers kind of knocking around. So no huge concerns there, but lots to think about for operating leases. So that's what the standards say. What can you do? What can you do either right now, or should you have been doing a few months ago, or what will you be doing in a few months' time? I think our number one piece of guidance is just build that list of leases. Make sure you're really, really confident with all the leases that your charity currently has. Start thinking about them, whether or not they were operating leases or finance leases under the previous, the current SORP that you're using. And then lease by lease go through and start thinking about what some of those detailed terms and conditions are of the lease. Think about consideration, what's been paid and how much and when does that change in future years. Think about break clauses, maybe start applying some of that judgment and documenting that judgment about whether we're reasonably certain that we're going to extend the lease or terminate it.
And you might need to be getting those charged with governance involved.
Absolutely.
In some of that decision.
Yeah, I mean, I can see this being a very beautiful board paper going to a committee perhaps that says these are our leases, this is how we want to treat them going forward. Yeah, absolutely. See, also, you've built that list of leases. I think that's a great place to start. But start thinking about how they're going to affect your primary statements. If you've got lots of operating leases, all of a sudden your balance sheet is going to be grossed up quite significantly by the valuation that you put on those right of use assets and those lease liabilities. Depreciation is going to increase quite significantly as well as you start depreciating those new right of use assets, but your rental costs might start going down as well. So a few things to consider there in terms of the financial statements. But of course, financial statements mean different things to different people, right? I mean, if you've got a bank loan that's got covenants based on the information in the financial statements, start thinking about how that might change. It might be time to pick up the phone to the bank and start explaining how we might need to amend those covenants. Also start thinking about audit thresholds. If we are a relatively small charity that actually doesn't require an audit under the asset thresholds, that might change, and it might be that you get caught and fall underneath that umbrella of needing an audit. Yeah, I think one of the key judgments that you highlighted earlier, Joanne, was about that discount rate and the various different types of rates that FRS 102 asks you to choose from or kind of go through in order before determining. That's a massive judgment, and it will have such a big effect on how you value both the asset and the lease liability. So again, it's another judgment that you may want to document. You may want to detail that in your list of leases. Maybe that's the paper that goes to the committee as well. Yeah. Certainly want to support that judgment. And then start thinking about financial reporting processes. That was another thing that we were talking about internally. If we're regularly entering new leases, how do we make sure that they get added to a list and assessed at the same on the same extent as those transitional leases? Do we have that process in place? Absolutely, yeah. You're going to want to know that maybe even before you sign up to the lease. So is that process in place? Is there a policy that mandates how the charity treats those? And it might be that if you introduce a new policy, you might want to start training the staff who are involved in it. You might want to start training governance. This is certainly not an exercise that's going to need to be silos to management. I think you're going to want to talk upwards. And hey, start engaging with your professional advisors. We're friendly people. We like talking about this kind of stuff, but we're covering things at a very theoretical and later in the examples a rather kind of basic level. You will undoubtedly have specific circumstances, specific leases that will have weird and wonderful clauses that you might need a bit of attention with. So get talking to your advisors and you start modelling how the new framework might impact on your lease accounting. Yeah. So lots of practical tips. I hope that helps. We've had theory, we've had transitional considerations. Let's try and put a bit of life into this and think about some scenarios. We've got 4 to talk you through: a plain vanilla lease, a slightly more complicated lease, and then a social donation and peppercorn lease to highlight some of those matters that Joanne was mentioning earlier. Let's start with plain vanilla. So in this scenario, we have a charity. It's leasing a new office building. And the terms of the contract are, thankfully for our example here, rather straightforward. We're commencing on the 1st of April, 2026. Oh, that sounds like a familiar date. I better start applying my new SORP here. I've got a 5-year lease term and there's no break clause and there's no option to terminate that. Yeah, nice and simple, just the 5 years. Our lease payments are £50,000 a year. They're payable annually in arrears. And there is no lease incentive. There's no dilapidation provision. It is a plain vanilla lease. The charity, no external borrowing. It doesn't hold surplus cash, but it does hold surplus cash, sorry, in its deposit account. And it earns 5% interest with that. So there's some detail. Let's think about our initial measurement. I'm going to start with that lease liability. And hey, as Joanne was saying, you know, we're going back to college here. We're getting our discount factor calculator little formula out again. And we're considering what the interest rate is. In this scenario, I don't think we can really use anything but 5%. There's nothing in the terms and conditions of that suggests that there's a rate that we should be using otherwise. And similarly, I don't think we can really use a period other than 5 years. In this example, there's no break clause, there's no option to terminate. It's 5 years and out. So we pop that into our little formula. We get our discount factor of just over 4, and we're multiplying that by the future, well, by the annual lease amount, and that's a stable lease payment throughout, such that our lease liability is just £216,450. Nice and formulaic. Nice to get the calculator out again. Nice to get the spreadsheets working. That is the cost of our right of use asset. Nice simple double entry. Debit my asset 216, credit my lease liability 216. When you credit your lease liability, you need to split that between current and longer term liabilities. So again, a bit more calculation to do. Going forward, and let's envisage that we are at the end of our first year. Let's again think about that lease liability. It increases as our interest rate unwinds, but it decreases by the lease payment that we've made. So our 216 goes up a little bit, it goes down a little bit, and it ends the year at £177,273. Nice and precise. Our right of use asset, though, which we're depreciating on a straight line basis over the length of the lease, 5 years, incurs only £43,000 of depreciation. We need to consider impairment at each year end, but for the sake of this scenario, let's assume that there was no impairment to consider. It means that the carrying value of our right of use asset at the end of that first year is £173,160. So it's different. We have our timing difference. And so when we think about that over the remainder of the period of our lease, you'll notice that your lease liability at each year end is greater than the value of the asset, and it only really levels out right at the end. Right, so we've gone through the workings. We've just applied that straight line depreciation to each of the assets, to the asset and in each of the years, and we've also applied that same formula of increasing the liability by the interest and decreasing it by the payment to get our closing liability. Right, so those liabilities will be different from the assets. That will impact your balance sheet, as we were saying. You might want to start considering how that impacts it.
The wider implications.
Yeah, absolutely. All right, plain vanilla lease out the way. Let's think about a more complicated lease, shall we? So again, we've got a charity. It's entering a new lease agreement and it wants to rent a centre to run its youth programmes. That sounds like a good charity. The lease commences again on the 1st of April 2026, another familiar date, and it covers an initial 5-year period. However, at that point, the charity can extend it for another 5 years, and that's an option it's very keen to do because it's going to have to be investing in modifying the space that it's running these programs from. The annual lease payment, again payable in arrears, is £200,000 this time, but the charity were a bit savvy. They got negotiating, they got their bartering hats on, and they managed to get a 6-month rent-free period from the commencement date. It's a good saving there. Maybe that will help with some of those modifications. Those modifications, however, the landlord not very happy about them at all. Right, so the lessor has included a dilapidations clause in the agreement, and the charity, come the end of the lease, will have to return the centre to its original condition. To fund all of this, the charity is extending its existing debt facility, which it pays 4% on, and there we have a couple of things to unpick. Again, I'm going to start with lease liability. I think it's got the most to kind of go through in our calculation. And I'm going to start with the fact that we've got variable lease payments throughout the term of the lease. And it's that first year where we had that 6-month rent-free period, we're actually only going to be spending £100,000 on leasing this space, right? So I'm going to discount that separately, all right? And I'm going to work that out, discounted value, just over £96,000. I've used 4%. In that calculation, again, because I don't think the scenario gives us any other indication that there's a more appropriate rate to use. We're using the amount of the existing debt facility. And then I need to think about the rest of the term. And again, get my little present value calculation out again. Again, I'm going to use that 4% in my formula. I don't think there's a different rate. My remaining number of periods is 9 years because we've already considered that first year. And I'm saying 9 plus 1, 10 years in total, because the scenario suggests that the charity are going to extend when it comes to that break clause. They want to take up that option. It's reasonably certain, that buzzword, that they will. So I'm using the remaining 9-year period in calculating that value. So my annual payment after the first year of £200,000 multiplied by my discount factor, I get 1.429 million. I'm going to add my discounted lease payment from that first year to calculate a total lease liability of £1,526,025. Again, the right of use asset side, nice and easy. That's my cost. They're the same value. Very straightforward, debit and credit. In it goes. When we start thinking about our assets, again, we're just going to depreciate that on a straight line basis over the length of the lease. So a tenth of that opening asset value each year. When it comes to my lease liability, again, I'm applying that same formula. I've got my opening value. It's going to increase by the value of that interest, that judgmental rate that I've applied. It's going to decrease by my lease payments, and note that my lease payments are different in that first year from the remaining 9. And so again, my lease liability goes down as does the asset value, but again, at very different rates. So at the end of my first year, I've got a liability of 1.487 million. But if we just take a step back, my asset's worth only 1.37 million. That's almost £100,000, just over £100,000 difference between my asset and liability. So the difference of that is going to my SOFR. That's going to impact my result for the year. So again, we're starting to see how some complications in these leases are really going to impact our financial statements, and thus, the decisions we make thereon.
Yeah.
Let's think about a social donation lease now. Our third scenario. So in this one, we've got a charity. They're looking to lease a new office. All of these charities moving around in our scenarios. They want to do it for a 3-year period. They've set aside a budget of £72,000 per annum for the space, and that budget's been funded by a bank loan that they're taking out specifically, which charges us 5% interest on that amount. So off the charities team go, they go and have a look at a nearby office building in which one of the 5 floors is available to rent. Happy days. The other 4 floors are let to commercial entities for £120,000 a year. Or not sure if we can afford that. So hey, the charity goes and talks to the landlord, who thankfully has a corporate social responsibility program and offers the charity a 50% discount from what it's charging its other tenants. Because of the charitable nature. Charity thinks, happy, this is brilliant, this is good news, I'm going to take up their offer. They sign the lease agreement. So let's go through our calculations again. Let's start with our lease liability again. Let's go and work out the present value of those lease payments. My formula is out again. I'm applying a 5% interest rate here. Again, I don't think the scenario suggests that there's anything but a 5% rate to apply. The number of periods that we need to consider is 3 years, the length of the lease. And again, doing the maths, tapping it into my calculations, I've got a lease liability of £163,000. I then think about my right of use asset, and I think about the cost of that, and I need to consider the discount that I'm getting from my landlord, right? So the value to the charity we've calculated here as being £12,000 per year. And that's the difference between what we would have paid, our budgeted amount, that's £72,000, and the amounts that we're actually going to be paying each year, £60,000. So the difference there we need to consider. So actually the value to the charity is that budgeted amount. And when we multiply that £72,000 by our discount factor, we get an asset that's worth 196k. So we have a difference. We can't have a lopsided double entry, so we need to consider the non-exchange element of this lease, our social donation, and that is our income proportion. Now, we've had a bit of discussion internally about, once I calculate that, that's that £12,000, the difference between what I'm actually paying and what I would have paid under my budget, multiplied by my discount factor, that £32,000. Well, should I recognise that all up front? Should I defer it and then release it over the length of the lease? I think it's judgmental. I think our judgment lands quite firmly on one side of the fence, though, that you should recognise that in line as if there were performance obligations associated with this income and defer it. You recognise that over the course of the lease because you only really benefit from it if you continue to exercise and see out the lease, right? You don't get that benefit up front in one go. So we'll see shortly that our decision is that we might want to defer it. In subsequent years, again, our lease liability, we apply that same formula that Joanne talked us through earlier. We're increasing it by our interest rate. We're decreasing it by our lease payment. We end the first year with a liability of £111,000. But our right of use asset, being depreciated over a straight line basis and assuming that there's no impairment to consider at the end of the first year, that's £130,000. We've got assets greater than liabilities, but as we said earlier, we think there's another liability being our deferred income proportion, right? So we recognise that total social donation element of the lease as deferred income enough at the initial application, and we unwind it over the course of the lease. So a bit different, but hopefully some kind of familiar concepts there, especially considering the first two examples, and just that income element that requires a bit of extra judgment. Final example is our peppercorn lease. So in this example, we've got a chair of a charity who's bragging at a fundraising event to a wealthy donor all about the recent successes of their sports youth program. The chair is explaining that she wants to develop more sports programs, but in order to do that, she needs more sports pitches. The charity needs more. So she thinks, she can probably sign off £200,000 in this year's budget and in foreseeable futures budgets, and carve out £100,000 maybe to develop the land that they want to rent into a state-of-the-art sports facility. Sounds pretty good. What's even better is that the donor is coincidentally a very wealthy and philanthropic local landowner, and was previously a professional footballer and offers to lease the charity some of its company's nearby land to develop those sought-after sports facilities. They've got a corporate social responsibility program as well, and doing so would be just the ticket. They agree, though, they know each other, but they think that a formal agreement would probably be best. And so they sign up, they get the legal bonds involved, and it's 10 years, and the charity's going to pay a kind of, nominal £1 annual rent. Yeah. So, as we kind of alluded to earlier, this is a peppercorn arrangement, right? There's no economic substance, really, in terms of the consideration being paid. And so at that point, it doesn't meet the definition, FRS 102's definition of a lease. So we forget about leases altogether. This is nothing to do with leases. Yes, it might look a bit like a lease because there's an agreement in place, but this is no lease. This is a peppercorn arrangement. This is straight up a non-exchange transaction. And so we need to value this donated facility that we're getting at the value to the charity. And so that's what we would have paid on the open market for it, were we not getting it for free. And as the scenario suggests, that's the £200,000 a year that's in the budget. So quite simply, credit our income £200,000, debit our expenditure £200,000 for each year that we're involved in this arrangement. Nice and straightforward, hopefully. So hopefully those four examples give you a bit of flavour to some of that theory, some of those first day implication considerations. Joanne, do you want to take us through a couple of key takeaways before we go to Q&A?
Yeah, thanks, Joe. So just to kind of round up for this afternoon is just to reflect on some of the key takeaways. And I think we wanted to kind of highlight at the beginning is that, this is applicable for all charities. And so this is not optional to kind of pick and choose as part of the SORP, and operating lease accounting for leases disappears. So that's why you've got to follow through the module 10B in terms of identifying have you got a lease in place and how you account for it. As Joe's mentioned as well, where you see your numbers change, your balance sheets will grow in terms of your gross assets. And so that will be something to be mindful of, impacting your assets as well as your liabilities, and particularly for those that may have not had many of this on their balance sheet before. Thinking about discount rates, it's a judgmental matter, as are many other kind of factors within looking at your leases. And I think highlighting that obviously quite a few charities probably don't have the borrowings and probably don't have anything explicitly noted in their lease arrangements. So thinking about what kind of deposit rates you may have to help contribute to making that decision. Your SOFR volatility can change, particularly with your depreciation and interest not being straight line with your previous accounting of your rent payments. And so that's something to be mindful of. And then that will ineffectively impact your reserves. Obviously, you'll be looking at your first day accounting and looking at your opening balances, but then also thinking about ongoing reserves and your free reserves, and what would you consider within that category?
Because they often, free reserves take out tangible fixed assets, don't they?
Yes.
Of which we're going to have a lot more.
Yeah.
So it might be time to revisit that reserves policy
and
include associated lease liabilities as well.
And I think that also ties in with maybe looking at your accounting policies for fixed assets as well, because you might be actually having some new categories of fixed assets joining on your balance sheet, which you may have not had an accounting policy, or thinking about the useful life, or even the kind of basis of depreciation. Are you using straight line? If so, will that give you a bit more of a difference between your liability, or will you be having a kind of reducing balance, which may bring it a little bit more in line with your liabilities? So that's something also to be aware of. Yeah. And then finally, we just wanted to highlight, obviously, the implications on your financial ratios, particularly maybe in your bank covenants, asset-related reporting and audit thresholds, which has wider implications, whether that's regulatory or kind of financial reporting to your stakeholders. Yeah. So that kind of summarises our sort of webinar, and
2 minutes over,
things to look out for. We will take it to the questions. If anyone's had any out on the Q&A.
Let's have a look. We've got some in the Q&A.
Hi, Joanne and Joe. Yeah, I can field some of those if you like.
Yes, please.
So the first one is from Julia Milne. Great question. If the lease is for a group of assets, e.g. phones, tablets, would they need to be treated as one item, or can the low value exemption be used?
What a great question. Yeah, I think there are two options.
I think it depends on what kind of absolute item it is in terms of the individual item of low value assets that are in the exemptions, right? So
yeah, because I think you actually could treat them individually and treat them as low value and be done with it. Alternatively, I think the SORP and FRS 102 permits the grouping of assets that are very similar in nature. And if the lease terms are also very similar in nature, 50 laptops, 50 phones, all under the same term, then you can, combine them together and treat it as one lease. And at that stage, it might not be low value. So there might be a significant judgment being made there. And actually, you might see it as a benefit to have the assets and the lease liabilities on the balance sheet. So I think it's optional.
Awesome. Yeah. Up to your accounting policy, perhaps. Yeah. Interesting. Next question. Andrew Bagley asks, how would I treat a property lease on a 12-month rolling contract?
Okay, so I think if the terms within that contract is effectively saying it's on a rolling basis, I think you'd need to determine, is there any intention to extend that? And if there isn't necessarily, then you would be within the 12-month period of the term and maybe considered as a short-term lease. But I think it's something to be mindful of, that actually if there is the intention to extend it and you're probably there for a longer period of time than the 12 months, you'd have to think about that enforceable term of the lease. Yeah. So I think it would depend on the intentions of using that.
How reasonably certain are you, Andrew, that you're going to continue rolling forward that contract?
fantastic. And I suppose we can always look back at history as well. If you've been rolling it forward for the last 12 years, then that might indicate something. Right, next question, Jackie Rees. Right, you've got to have your pens and paper at the ready here. If I had, it's like an exam, if I have a 3-year office lease ending in June 2026 and expect to sign a new 3-year lease from the 1st of July 2026 with a 6-month break clause, does the new accounting commence on the 1st of July 2026? My year end is December.
Well, that is like a definitive quiz test question, isn't it? My goodness. Okay. I'm reading through it as well.
So let me just go over that. So we've got a year end of December. So
Yeah.
presumably we're straight into the first, first day of accounting period is January 26th. So we're in it.
Yeah.
Come 6 months to the end of June, Jackie's going to sign a 3-year lease. Well, in fact, her lease ends, in June, and she's going to sign a new one, 1st of July 2026 for 3 years, but it has a 6-month break clause, which will take you up to December 26.
Yeah.
So
I
the
love
question really is kind of what do I do? But do I need to do anything for the first 6 months, or do I just go for the 3-year lease thereon?
It's what a great question. Almost as if it was planted. I think it's it goes down to those transitional arrangements. The 1st of January, we do need to consider this existing lease, and if you consider this existing lease in its own right, then it is less than 12 months long. I don't need to change my accounting treatment for it. Leave it as be. If the new lease that's been signed is arguably the same as the existing lease, it's almost as if it's an extension, then you might want to consider at that point, actually, am I reasonably certain, is this a modification to an existing lease? Am I considering the new and the old together? If so, going back to the 1st of January, I would argue that you do need to consider that and make transitional adjustments for it. But on top of all of that, consider the reasonable certainty of extending beyond that break clause. Because even if you consider the two leases together, but you are reasonably certain that you are going to exercise that break clause, then at the 1st of January, the combined leases count as a short lease, and you don't need to make a change for it. Whew. Did I pass the exams, Stu?
I think you did. So lots of things to consider there, Jackie. Yeah. Susie now asks, should you adjust the interest rate over the period of a lease as the deposit rates change? Someone has been watching the Bank of England base rates being held today, I fear.
Effectively, yes, I would have said. And I think this is where we would kind of say the kind of first day of accounting, you'd have obviously identified what your deposit rate is, use that for your calculation, but then we'd say reassess at the year end to determine has that changed for your future lease payments. So it will have an impact on that calculation. Yeah,
I think that discount rate just becomes another key estimate and judgment that is used in preparing the accounts, and so hopefully you're already documenting the existing estimates that are being made in your accounts, whatever they might be, and kind of reassessing those periodically. So it's just another row to that table, I think. Yeah.
Awesome. Thank you very much. Right. Last question at the minute, although I will refresh, from Jamis Jabbar, asks, will a provision for dilapidations have to be recognised as part of a peppercorn arrangement where renovations have taken place?
On the basis that it's potentially some costs that you're expected to have to spend in the future, it would make sense to have a provision in place, and I think that would tie in with your usual accounting treatment, regardless of it being a peppercorn arrangement, because effectively it is actually costs that the charity will incur in the future.
Yeah, dilapidations aren't exclusive to leases, are they? It's just a provision.
Yeah.
Lovely. Well, that is all of the questions that we have in the Q&A function. There's nothing in the chat. So unless anybody has any final questions they want to quickly type out now, You may well have passed the exam, you two.
It is nice and techy. I quite like it. It's it's mathsy, and it's there's calculations to determine the variables they're in. But in some ways, I think that kind of lends itself to management teams because they'll be able to just really clearly set out those workings, I hope, and judgments made therein. But yeah, it should be a fun exercise for everyone involved.
I've got one final observation, if I can, Joe and Joanne. I was on a call today, and we were talking about the impact of leases on reserves, and it's rather fortuitous that if you go back to one of our earlier webinars, it talks about the narrative reporting and how SORP 26 now codifies that you're required to perform a reconciliation between your funds on your balance sheet and what you're classifying as your free reserves, and in a way that'll really help users understand the big jump in balance sheets, and that actually how that doesn't always have to affect free reserves, and you can actually codify and quantify and demonstrate that quite easily now with the new SORP. So that was a nice little bit that we talked through today.
Nice. So it's relevant, it's happening already.
Okay, well, I think we'll probably just end there then. Well, thank you everyone for joining us today. As I previously mentioned, the recordings will be available in about a week's time, give or take, just to tidy it all up and make it friendly for the website. So thank you all and have a good afternoon.